Hello, this synopsis is on chapter 11, which deals with exchange rates and bubbles. And so this is a short chapter, and it won't take us too long to go through this. All right, so first off, let's go to bullet 2 here, because this is a review for you from the first exam and the paperback book. So remember the question about the effects of a strong dollar, how a strong dollar is good for U.S. consumers because it makes everything cheaper for us if we travel or if we buy any imports, and it's bad for producers because it makes our products more expensive, and it also is bad for producers because if they're doing business overseas, when they convert the money back from the foreign currency into dollars, you're hurt by the exchange rate. Okay, so this is just explaining the same thing, but in explaining a weak dollar. So it's just the opposite. So when they say devaluations here in the book, that just means a weak dollar. So let's say the dollar gets weaker. Well, if the dollar gets weaker, that's going to hurt consumers. It's going to hurt U.S. consumers because it's going to make imported goods more expensive for us. If we travel abroad, it's going to make it more expensive. But it helps U.S. producers because it makes our goods cheaper. So it makes our exports cheaper, and that helps obviously helps U.S. producers, and also it also reduces the trade deficit. Also, a weak dollar would help foreign consumers because they're buying our exports. It makes it cheaper, and if they come to the U.S., it's to go to Disney World or what have you. If they come to the U.S. as tourists, their currency goes further along. But it hurts foreign producers because it makes the imports, it makes the goods that they're exporting from their country into our country more expensive. Okay, so this is just saying the same thing that we were talking about in the other book, but it's just talking about devaluations versus saying a weak dollar. And it's just talking about a weak dollar or a weak currency in the home country versus a strong. Okay, now let's look at another aspect of exchange rates and what can also happen if a currency appreciates against another currency. So now we're back to a strong dollar. Okay, so exchange rates are determined by supply and demand. If there's an increase in demand for a particular currency, then the value of that currency is going to appreciate relative to other currencies. So the dollar is seen as a safe haven. So during times of turmoil, especially, there's kind of a rush to buy dollars and to invest in dollars. And so that helps our currency to appreciate, to make a strong dollar. Also, if interest rates increase in the US as they're increasing now, think about the whole world, or think about the global issue. You're a saver. You've got money you want to save. Well, anyone can come and save in US dollars. So if our interest rates are higher compared to other countries, then that's going to increase the demand for dollars because people are going to want to be saving in our currency. So that's kind of what I'm talking about in this first paragraph. Okay, so exchange rates are determined by supply and demand. If there's an increase in demand for a particular currency, its value is going to appreciate relative to other currencies. So here's my example with interest rates. If interest rates increase in the US, then savers worldwide are going to want to invest in the US. This is going to cause the demand for dollars to increase relative to other currencies. So the US dollar will become stronger in the exchange market. And anyway, so that's just another take on the currency issue. Okay, then towards the end of this chapter, they talk about bubbles and how bubbles are a really interesting phenomenon. We had the dot-com bubble in the late 2000s. Excuse me, we had the dot-com bubble in the late 1990s. And then we had the housing bubble, 2003 to 2006, 2007. So what's the deal with these bubbles? I mean, how, you might ask yourself, how could people have been so stupid to continue to invest in the market, continue with this, when this dot-com bubble was going on in the late 1990s, the stock market was going up like 20% a year, pretty much for the last 3 years. And people just kept, investing in the market, knowing that that wasn't sustainable. It was going up 20% or more. Well, and then fast forward to the housing market. Everybody knew that, housing prices going up 20%, 20% a year wasn't sustainable. And yet people just continued to buy homes. So how does this happen? Because eventually these bubbles are going to burst. Well, you can tack it up to human nature. Greed and fear, I guess, is the way that you would sum it all up, because the bubble's going to burst, but you don't know when the bubble's going to burst. And you want to be on that ladder making money. And so people were buying stocks and in the market because they didn't know when it was going to burst and they didn't want to get left out. There's the greed factor. Same thing with housing, the housing market. People didn't want to be left out. So they were buying houses and then selling homes and getting lines of credit and trading up and buying, just continuing to buy homes and moving up that home equity ladder, so to speak, because nobody knows when it's going to burst. But eventually fear overcomes greed and there's more selling than buying. And when the selling starts, then that's when the bubble burst. And so what happened with basically what happened with the dot-com bubble was eventually people realized, well, these dot-com companies aren't making a profit. So, and their PE ratios are really high. So the prices of these stocks were really high, reflective of compared to their earnings. So the prices just kept going up, but most of them had negative earnings. And people just overlooked that for several years because they thought that there was this hope in this whole dot-com phenomenon. But eventually people got back to reality and said, well, these companies eventually have to make a profit. The prices are just too high. And so people started selling, and that's when the bubble burst. With the housing bubble, as you kind of read about that a little bit in the last book, interest rates going up basically caused it to burst, because when interest rates started to go up, people started foreclosing on these subprime mortgages. Then the banks quit lending, they tightened credit, quit making these loans, and the whole bubble just burst with the housing prices. So here it is, April 2022. Are we in another housing bubble? Some people are saying that we might be in a housing bubble. It's not to the magnitude of the 2004, 2006, but housing prices are going up like crazy. Housing prices are going up in a way that's not sustainable. And so what's happened in this case is we've had really low interest rates. We've had a COVID situation where people have some extra money, and they're also, a lot of people are wanting to move to bigger homes and what have you. They've got the money, low interest rates are low. And also because of COVID, supply is really low. So you've got this increased demand and a decreased supply, you've got a housing shortage, a classic housing shortage, and that is fueling the bubble. So interest rates are going up now. So when interest rates increase, that makes people's mortgage payments higher. So that tends to drive down the demand for housing. So will increasing interest rates cool this housing bubble? Well, maybe, but you've got another issue here. You have a shortage of housing. And so some economists are saying, even though we have this even though we have increasing interest rates, they're really still not that high. You know, a 5% mortgage is not really that bad. And we still have this shortage of homes. And so they're saying that it's going to take maybe till 2023 until this shortage of homes catches up, you know, until the supply of homes rather catches up with demand. So we may, you know, we might not see this bubble burst. We're in a little bit of a bubble, I think, but we may not see it burst for a while, because it's going to the increasing interest rates will slow the market down a little bit, in my opinion. But you still have the issue of increased demand and not enough supply. You've got a bit of a shortage. So it'll be interesting to see what happens with this current housing market, because in a lot of markets, you've got people bidding up the prices way over the fair value, and it's just really crazy how much housing is appreciating. So that's kind of illustrating how these bubbles are the result of a self-fulfilling prophecy. Because what happens, remember back in the supply and demand chapter, what happens if there's an expectation of an increase in future prices? Well, if you think that housing prices are going to continue to go up and you're in the market for a house, you're going to hurry up and buy, okay? If you're a seller and you think housing prices are going to continue to go up, you're going to hold off. And so that just exacerbates the shortage, you see. So demand is increasing, supply is decreasing. Think back to those graphs. That's going to decrease the quantity. That's going to decrease the supply, increase the demand. It just, that just increases the price even more, and it's just a spiral up. So that's the kind of the situation that we're in right now. People are expecting the housing prices to continue to rise for the moment, and we've got this shortage going on. So I think we're going to see this issue for a few more months, maybe a year or two, who knows? I mean, you can't predict these things. I'm just guesstimating, but that's kind of the self-fulfilling prophecy of a bubble with it. When there's an expectation that that prices are going to go up in the future, that increases demand on the demand side, but it can decrease the supply on the supply side, because, as I said, people are waiting for prices to go higher. Then it's just the opposite effect once the bubble bursts. So think about the 2004 to 2006 housing bubble. When it burst and prices started to come down, they were coming down for a long, long time. Because this is why, if you're a buyer and prices are going down, what are you going to do? If you're in the market for a house and prices are coming down, you want to buy at the bottom, right? So you're going to wait as long as you can, because you want to get the bottom, get the best price. So buyers aren't in any hurry to buy anymore, but now the sellers are in a hurry to sell, because they want to sell before the price falls sooner. So that causes an oversupply of houses. So it's really interesting to study these bubbles. Okay, so you can go all the way back to Holland in the 1600s, when they had the tulip bubble. The Dutch tulip bubble is one of the most famous bubbles, where, you know, in Holland, they like their tulips, and they crossbreed tulips, and they had all these very exotic tulips that they were selling. And when I have an undergraduate finance book that says in today's dollars, some of these tulip bulbs were going for $70-some thousand, like $72,000. And so it's a greed and fear thing. People were buying these tulips, greed, 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 greed. All of a sudden someone says, well, you know, it's gone up to $70-some thousand, or let me sell. I should probably sell. One person sells, then another person sells, and then it's a domino effect. Fear overtakes greed, and you have the bubble burst. Okay, so you can use the indifference principle to try to actually tell when when market prices have deviated from their long run equilibrium, i.e. a bubble. Okay, so there's two, this is really interesting. This man by the name of Schiller actually predicted the dot-com bubble, and he predicted the housing bubble. So this is pretty interesting. So this is on page 149, section 11.4. So you're going to learn about, if you don't remember what the PE ratio is, it's the price of the stock divided by the earnings per share. All right. So look at this chart. The normal PE ratio for stocks is, it ranges around 15 to 18. Okay. So look at what happened during the dot-com bubble. Okay. So you have this normal PE ratio. The PE ratios for companies went all the way up to the average PE ratio for the market for US stocks was at 44. I mean, that is just crazy. So that tells us that the price of stocks in the US stock market was way up. They were way overvalued compared to their earnings. So this was a clear indication of a bubble. But look at what happened here. This started, well, here's the average. This is 1988. So you can see why people, get caught up in these bubbles, because this started in 1988 and lasted all the way until 2000. It was actually April of 2000. So you lost, you think about that. That is 12 years. If you were saying, oh, there's going to be a bubble, I'm not investing in the stock market, you lost out on a heck of a lot of gains. So again, it speaks to you really just have to stay the course in the markets. That's a whole nother story or lecture that I won't go into. But you can see why people got caught up in this bubble, because it lasted quite a long time. I mean, the actual bubble wasn't until around here. But anyway, if you see that, the market is, you could have actually seen it in 2004, 2005, but it did go on for another 5 years. That's a long time to be predicting the burst of a bubble. So anyway, Schiller he was eventually right in 2000, and he predicted the bubble. And so it shows that, yeah, there was a deviation from the long run equilibrium of the average PE ratio, which is usually around 18 or so in the market. Okay, then this other bubble, the housing bubble, is really interesting. This is even easier to see. Right, this is, well, here, look at this. First of all, make sure you look at that chart. That's home ownership. Remember, I was telling you that they decided they wanted to increase home ownership in the early 90s, late 80s, early 90s. Well, it was mainly early 90s. They did increase the home ownership, but they did it by giving subprime loans, which caused the housing bubble. Schiller predicted the housing bubble by looking at the price of rent to the price of buying a home versus renting, basically. So it's your mortgage payment versus rent. And so it's usually a 1-to-1 ratio. You can see there historically, it's a 1-to-1 ratio. In other words, you should be pretty much indifferent between renting versus buying. But look at what happened here. The price of homes went up so much. So the cost to buy went up to 1.8 compared to the cost to rent. So again, this started in 2003, lasted until 2008, and then the bubble burst, and you see they came, and then the prices came crashing down, and then it became a more equilibrium ratio. So he was correct. He was saying the long run equilibrium of rent to buy is off. The housing prices cannot be sustained at this level, and he was right. So that's the housing bubble. So will we have any more bubbles? Are we in a housing bubble now? Maybe. Will we have another bubble in the stock market? Probably, because human nature is human nature. Is a bit, well, think about Bitcoin. Bitcoin is a bubble. Bitcoin was up to 60 some thousand. Now it's down to 30, 40,000. Will we have a crypto bubble? Probably. There will be bubbles in the future because it's human nature, the greed and fear factor. Okay, so this chapter, as I said, fairly short. Read about the exchange rates, the supply and demand for a currency. Review the second part, who benefits from a weak dollar versus a strong dollar. What are bubbles? Why do they happen? And when do they burst? And read about Schiller, who was successful in identifying the last two bubbles we've had, housing and .com. All right, that is it for chapter 11, and I will see you next time when we discuss chapter 12.